Good morning and welcome back to Real Estate Mindset. Are you getting discouraged about the house market? If you are getting discouraged, don't. Have you lost hope about finding a great deal? If you have lost hope, get it back. You guys will need it because things are changing. Maybe not as fast as a lot of us wanted to, but things are changing. And today we're going to try to figure out and we're going to talk about, are we moving into, it's hard for me to say this because it's obvious, but are we moving into recession? And are we at the beginning of a rate cut cycle? So those are things we'll talk about today. And, some of the other things we're going to look at today, you guys, we'll do a little bit of training on pricing alone. We'll do a little bit of training on MLS and adding filters. We're going to listen to several Fed officials talk about what's going on with residential mortgage rates. And I'm going to show you guys also the current health of the consumer, what the recessionary indicators are right now. And then also, where's the inflation coming from? So we'll also look at liquidity as well. But you guys, I really want you guys to be able to answer this question. You should already know the answer to this question. But by the end of this, I really want you guys to be able to answer this question. And if you already know it, comment below. But what are the three main leading indicators? So what are the three leading indicators that I've been telling you guys to watch and that I've been watching that is suggesting that we will have pretty massive price decline this year? And that's in the face of historical high value. So again, why is Real Estate Mindset saying that? Why am I saying there's going to be nominal, not real? Well, there will be real, but also nominal. Why am I saying that? What are the leading indicators? So I want you guys to answer that now as more and more people come on. What's up, buddy? I got all my buddies. There's Jungle. I wanted Jungle to join me today. He's going to join me another day. I think he's got family in town, but I want to get this man on here as a huge part of the community. Vovo, I don't see you in Discord. There's Grilled Cheese. Oh my God, Grilled Cheese. Grilled Cheese is a farming man. The conversation right before we came and did this. Oh my gosh, in Discord. Steve-O, good morning. Nightcry, good morning. There's my buddy Charles. Charles is a real good dude. I really like this man right here. Edward, good morning. Kim, good morning. Wicks, Charles. Oh my gosh, look at this, guys. Look, I put this to start here because look at this man. I mean, I'm so proud of our community. I don't want to see the division. I like to see the unity. So I'm so proud of Charlton. I'm so proud of you guys just, coming together. And as we get started here and more people come online, let me just give you guys a quick story and then we're going to get started on the mortgage rates. But my son's in town. So my oldest son's in town. Okay. He's 17 years old and I worked him hard yesterday. Me and him did a video yesterday going downtown Houston. I worked him for about 5 or 6 hours only. When I was his age, I go for 15 hours. But what we did, guys, is we did a very special video we made for you that's really going into great detail, boots on the ground on the commercial, okay, the commercial foreclosure crisis. We are up triple digits as far as foreclosures in commercial real estate. So the quantitative tightening is already having an impact in commercial real estate. And we visited 4 different properties. You guys, the first property was a skyscraper that halted construction. Literally a giant skyscraper that has halted construction. And to me, that's kind of a leading indicator. If you're going to halt construction in the middle of a project downtown museum district, that's an issue. So we're also going to, we took you guys also to an office, giant office building that's in foreclosure. Took you guys to a commercial multifamily apartment, a whole apartment complex, guys. 300 people in this apartment complex. Actually, almost 376 people in this apartment complex is in foreclosure. And then we also took you guys to a Hilton hotel that has already been foreclosed. So a Hilton hotel got foreclosed 2 years ago in 2022, and they are in the process of doing conversion. So they're taking the hotel and they're converting it to apartments, and it's supposed to be done in September of 2025. So we go there, guys, and I'm expecting all of this construction, right? Or signs of conversion. We get there, it's a ghost town. We get to the skyscraper, it's a ghost town. The interesting thing about the skyscraper is that company and the developer has been promising Houston for probably a year that they're going to start construction. In fact, the developer said they're going to start construction in June. So when I got there, I was like, you guys, I don't know if there's going to be any working going on here. So when we finally got to the skyscraper, not even one person was there. Not even one person. This is $100 million project. You guys, we have so much going on behind the scenes. It's absolutely crazy. And remember this as well. Okay. I talked to Jared Jones yesterday, and we'll get started with the interest rates here. And, Jared and I were talking, and he's like, man, so many people got it wrong in 2022. In 2022, we had massive price decline. And then why do so many people forget that? Well, number one is in 2022, we did not end the year with price decline, year over year price decline. So even though we had massive decline in the second half of 2022, exceeding the decline in the GFC, remember, it rebounded in 2023. But my thing is there was a warning. There was the warning sign that we all should have been paying attention to in 2022 as far as what's going to happen. And again, what are the leading indicators? What are the leading indicators that the same thing's going to happen right now? But again, guys, there was two problems. Number one, even though we had that massive decline the first half of 2022, prior to quantitative tightening, we had a massive run up in prices. So even though we had a massive decline, it wasn't quite enough until we got to February of 2023 before we even saw year over year decline. So that was one mistake. The second thing, and this is my gripe, I won't talk too much crap about clear Brian value. But, a lot of people were fooling you and talking about how 2022 was just seasonality. And the reason they kept that, premise of seasonality is generally the second half, or really not really the second half, but I would say like after the first three quarters, home values typically go down. And so it confused so many people because we had that decline during normal seasonal decline, and we did not end the year in 2022 with year over year price decline. So that is a huge reason why so many people are going to get this decline wrong, and so many people are going to get blindsided. Tell me I'm wrong, guys. How many people do you know that are not talking about what has already happened in the market? There's still so many people. Seasonality. They're not taking into consideration any of the leading indicators of recession and overvaluation in property value. I think that's a huge mistake. But either way, you guys, let's get started on the mortgage interest rate stuff. Sorry for rambling. So we're going to get started right now. What do I want to... Let's do this real quick. Okay, so we're going to start here, guys, by going into this article just really briefly. This is from Benzinga. I'm trying to get my picture out of the way here. Apologize for that, guys. All right, so take a look here. So September, and really the question is I want you guys to ask, like, why would they do this? Why would they do this? Why would they cut rates? Why would they cut rates? And don't get lost in any one person's narrative, okay? We're talking about the whole economy. Don't get lost in just one person's success or failure. Look at the big picture and understand the premises, okay? The timing and everything, it's very, very difficult. But as long as you guys are understanding the fundamental premises of what I'm trying to explain, you're winning, okay? So here's this article. September may bring rate cut, says former Dallas Fed President Robert Kaplan. I think there's a good chance. But why, guys? Okay, why? Comment below if you have some ideas of why would they cut rates. Now, Robert Kaplan, the former president of the Federal Reserve Dallas's branch, says in light of the recent progress of inflation, he predicts a potential interest rate cut in September. However, he does not anticipate this to mark the beginning, and here's the key, of a full-fledged rate cut cycle. Because why? Because they will not do a full-fledged rate cut cycle unless they need to save the banks. Agreed? Let me know what you think. Now, what happened? Kaplan, who is currently the vice chairman at Goldman Sachs, suggested that the Fed might consider a rate cut in September with the possibility of a second rate cut in December. Now, its path for September is pretty clear. I think there's a good chance they could do one more rate cut in December. He emphasized again that this does not necessarily indicate the start of a rate cutting cycle. Okay, so a lot of people are like, yes, oh my gosh, the rate cuts are coming. The rate cuts are coming, right? But here, okay, here's the thing. Odds are, if they cut interest rates, it's because they need to save the banks. And if they need to save the banks, that means they need to make more profit, right? The banks need to make more profit. If they cut the rates, do you guys think that they're going to pass that savings to the consumer? Or do you think that the banks are going to keep the margin to stay in business because they're losing money right now? I'm going to tell you guys, okay, banks will not automatically pass that down to the consumer. And remember this, you guys, the federal funds rate does not track residential mortgage rates. I'm going to show you right now, okay, I'm going to show you the period between 2010 and the end of 2015, okay? And you're going to notice that the federal funds rate was zero during that time frame, but mortgage interest rates massive swings. Okay, so let's start here. I'm going to show you this. So here's the federal funds rate. Okay, and again, this is what I'm trying to explain to you. Just there should be. So here's the thing: when they initially start cutting interest rates, as far as the federal funds rate, it's probably going to have a large impact on 30-year fixed rate mortgages because of the bond market. An initial impact, but as time goes on, I don't think it's going to have a huge change with that going down. But look at guys, this is the beginning of 2010 and to the end of 2015. Look at the federal funds rate. It was zero. It was basically 0 to 1/8%. Look at that. A lot of people don't realize we've already had 0% interest rates. The 0% interest rates were nothing new. It was absolutely nothing new, you guys. But here's what I want you guys to understand. Here's the concept, okay? Again, you can just, my opinion is my opinion. But here's what I want you guys to understand. So even though this 5-year period that you guys are, it's actually 6-year period that you guys are looking at here, okay? So look at, for 5-6 years, the federal funds rate remained the same, 0% to 1/8, okay? But let's look at what happened to mortgage rates. Okay, so even though, guys, this is what I'm trying to explain to you, so you guys understand how this is working and you don't automatically assume that if they cut the federal funds rate, mortgage rates will automatically go down. However, again, what I'm saying is there's so many buts, right? But there's probably going to be initial reduction as the market, anticipates a rate cut cycle. But look at guys, again, so when I put this overlay of 30-year fixed rate mortgages, even though the federal funds rate was 0%, lenders were still charging 5%. Look at this, 5%. They went down to 4% because they keep the profit, guys, right? Because if they're cutting rates, they're stimulating the market. They're making it easier for lenders to profit off of us. It's always us. You guys, I'm just so sick of it. I mean, they're taxing us like crazy. I just want you guys to understand how this works so you can adjust. Now, again, even though they were 0%, the max that it got down to was about 3.5%, you guys. Interest rates stayed in the 4s and 5s, a little bit in the 3s, even during a time with 0% interest rates. Did y'all know that? Personally, I think that's very, very interesting. I don't know what you guys think. But anyways, let's look at the 10-year. So all of that to say, what we need to be really watching is the bond market. Here's the 10-year. This is the long end of the yield, okay? Even though there's 20 years and 30 years, here's the 10-year. Now, there is movement this morning. This is interesting. So it's actually reversing the trend that it has been going. We have an increase, guys. We have an increase of 6 basis points with the 10-year treasury right now. What this is indicating to us is today, mortgage interest rates will be higher than they were yesterday. And the pricing, remember, guys, and I'm going to show you pricing, the pricing will be worse because this goes up. When that goes up, rates go up, or rather pricing goes up because it's the pricing that matters, right? Now, here's the 10-year. And again, look at what impact it's having on residential mortgage rates right here, y'all. So we're sitting at an FHA of 6.28%. By now, you guys should be, understanding that FHA is generally going to have the lower interest rates. Lower down payment is generally FHA. Conventional up here has 2 programs that I know of called Home Possible and Home Ready that allows you as a consumer to put 3% down versus 5% down. Regardless, FHA still generally lower interest rate. You can see it's even lower than a 15-year. It's even lower than the VA. This kind of changes a little bit, but usually that's the lowest interest rate. So when you combine the lower interest rate and the generally lower mortgage insurance with FHA, usually, guys, the only time that conventional beats FHA is if you have good credit and more than the minimum down payment. Okay? But take a look at this, guys. Here's the market's anticipate. This is crazy. Look at the market. So let's go over the market now. Okay? And again, guys, why would they cut interest rates? Stimulate. Okay? Why would they need to stimulate? Probably unemployment, probably the commercial real estate meltdown are some of the primary reasons why they would stimulate. But let's look at the market. So the market has basically locked in July. So basically no rate. And again, guys, I'm just going off of the market. I have my own opinions, but the market's saying absolutely no chance pretty much of a rate cut in July. But look at September. This has changed drastically. Look at this massive change for September. So now the market's like, yeah, they're going to 100%, almost 100% cut. The cut is going to start in September. Now, here's what's important. I've been hearing a lot of rumors out there that they're actually going to cut 50 basis points. I mean, if they cut 50 basis points, there's a problem, right? There's a problem. They need to accelerate. But the thing is the market, there's no data suggesting that. That, you know, I've looked at articles like the market's now saying 50 basis point cut in September. That's not true. This is only a quarter basis point cut right here. So the market is now convinced, 93.5% likelihood, that there will be a first rate cut starting in September, but only of a quarter basis point. Again, we can't really trust the market. Now look at it in November. This is interesting. Now they're saying in November, here's a second rate cut right here. So this represents a second rate cut of a quarter basis point. So they're saying 55% likelihood in November of a second 25 basis point rate cut. Now in December, very interesting. So overall, the market dynamic has shifted. The market is now pretty heavily, like 50.2% is pretty heavily leaning towards 3 rate cuts. It's been shifting between 2 and 3, a little bit on the 1. Here's 1 rate cut right here. Here's 2 rate cuts. Here's 3 rate cuts. Market's still kind of confused. They don't know what's going to, obviously, guys, they don't know exactly what's going to happen. But that is that. And again, if you guys can comment below, like, why do you think, honestly, why do you guys think that they would cut rates, right? There has to be a reason, right? They're not just going to cut rates. I mean, why are we going through all this pain? There's a reason, okay? So they're going to cut rates. Now, what I want to do, guys, let's just do a quick breakdown of pricing. So we're going to go into the more education. Okay, we're going to go into the training part of the video. You guys know that I always try to sprinkle that. I don't want to just talk about the problem. I want to also inject a little bit of education into your brains. So again, remember, as a consumer, when you're out there shopping your mortgage lender, you're going to usually get a better deal with the broker. You're usually going to want to shop 3-4 lenders. The first credit report, you have a grace period, so you can continue to shop your mortgage without an additional hit on your credit. But also remember, you guys, pricing. Okay, so as a loan officer back in the day, I used to call an AE or an account executive up and say, hey, I need help pricing a loan. And as a consumer, that's what should matter to you. Okay, it's the pricing or the cost of the interest rate. And I'm going to throw this up on the board right here. All right, so here's my little worksheet, guys. Here's going to be our training. Okay, so again, this is pricing a loan. And here's our scenario. Okay, so we're going to have a loan amount. And now here's the thing. This is as an example. These are not accurate numbers. We don't ever have like 1, 0, -1. It's always like 0.00, you know what I mean? So I've rounded this to make it very easy for you to understand, because remember, I want you guys to understand the concepts of what I'm saying, okay? So again, here's our scenario that we're pricing. We're getting a loan of $100,000, okay? We are putting a 5% down payment, and our credit score is 740. All right. Now, here's the first step. Here's the interest rates right here. Okay. So we have a 5%, we have a 5.5%, and we have a 6%. But I'm also adding something for you guys. I'm adding another column called right here. You guys may have heard me use this term. Again, I want you guys to understand this stuff. You may have heard me say LLPA. Okay. Loan level pricing adjustment. This is the hit you get on pricing. Okay, so I've done an example here. So we're only going to price out credit and down payment LLPAs. Okay, so if our loan amount is $100,000 and we have a 5% down payment, okay, look at this LLPA category. Okay, so you go to the down payment category. Okay, you go to 5%, and this is a hit or a fee of 1%. 1% of what, guys? The loan amount. So we know as far as the down payment, we're going to increase the closing costs by $1,000. Now, if I had a 10% down payment, it would cost me no additional hit. Now, when we go over to the credit section right here, okay, you guys can't really see the bottom one. It's basically saying if I have a 600 to 680 credit score, I have to pay another 1 point. If I have a 681 to 720, it's par or free. And if I have a 721, I actually get a break or a discount on the pricing. So because my credit score is 740, okay, this is hypothetical, remember, okay? So I'm right here, 740, sorry guys, which means I get a break on my pricing. So I come back here to my pricing, and it's actually negative 1,000, which means my pricing adjustment equals what, guys? 0, because it washed itself. My good credit washed the low down payment risk away, hypothetically. Okay. So now that I know my pricing adjustments is 0, now I can go back to the rates, which is 5, 5.5, and 6. Now remember what you guys are looking at, starting with that 5%. That 1 right there represents an additional cost of 1%. That is called a discount. Okay. That is a charge. So again, because I want a 5%, I would then add $1,000 back to my closing costs, because 1% is the cost, and that's 1% of the loan amount. Okay. Now, if I wanted to get a 5.5%, do you see that 0 right there? That means that 5.5% is free. That's referred to as a par interest rate. So if you ever hear the word par, that just means the interest rate you qualify for that doesn't cost you money. Now, if I wanted to get a 6%, first of all, why would I want a 6% if I qualify for 5.5, right? Because money. It's all about money, money hungry, hunting. So if I want a 6%, they will give me $1,000. So they will give me back $1,000, and that would give me a credit to help pay for the remaining closing costs. Now that I'm looking at this form, it looks super confusing, but I really hope you guys understood. I really hope you guys understood that. Did that make sense? I hope that made sense. It looks confusing, but just watch this over again if you guys want to see how that works. I can't tell you how important that is. Honestly, like no consumers know how that works. It's like day one when I'm training, or the first month when I'm training a loan officer. When I was training loan officers, like I would go over pricing so hardcore, and I'd explain to a loan officer like, hey, what do you think your job is, right? Like you got to do your due diligence up front. That's a loan officer's job. Like analyze documents. Like I love analyzing documents, especially income tax documents. I love it. And then your interest rate, right? You don't have to do a lot as a loan officer, but you got to do that due diligence and you got to track the interest rates, okay? To get your client a really, really good deal. Now let's go to our second. Let me change this real quick. Let's go to our second area of education today. And I promise, guys, this is it. I won't bother you with education, okay? I'm kidding. You guys know I like it. But here's an amortization schedule. An amortization schedule pertains to a mortgage. A mortgage is a death contract, okay? So a mortgage is a death contract. Here's what I want you guys to understand, okay? Because I hear a lot of comments that, like, if you're renting, you're going to pay 100% in interest. So let's see how much interest we would pay here. So I'm taking a $324,000 loan. Today's interest rate on conventional average of 6.81. Total interest I would pay in 30 years is right here, $437,000. When I divide that into the loan amount, that gives me an interest rate of 135%. You know, so the people are like, oh, Chavis, you're a fool. You're paying 100% in interest. You're making your landlord rich. Well, it depends on my landlord situation, because landlords are selling right now and are hurting across the nation, depending on the metro area. But you guys, that's 135%. If I'm paying 100% in interest, and they're paying 135% in interest by owning, I mean, you know, you got to weigh these things, is my point. And the crazy thing is, if I refinance, I got to start all this over again. Now, let me explain why you pay back $437,000 back in a mortgage. It's because now here's your amortization schedule. It's because it's front loaded with interest. Okay. So the first year you pay $22,000 in interest, but the last year, all you pay is $911. That's it. So it's front loaded. These mortgages are front loaded. So if I were to call my lender up and I were to pay, let's see here, if I were to pay $3,500 towards my principal, okay? So if I were to pay this principal down $3,500, I would save right here, this first year of interest, almost $22,000. Now, if I paid it down a second year to this amount, so if I paid my principal down $7,000, okay? So I pay my principal $7,000 down. Guess what? I now save $43,000 in interest. And the beautiful thing is, if I pay $700 on my principal, that's my money. That's my money, guys. I'm just paying the principal down. The $7,000 is my money, right? But what I'm doing here is I'm re-amortizing. The reason why this works is it reforecasts and it reshuffles, if you will, all of those payments. Isn't that crazy? But the thing is, guys, you got to do that. They're not going to tell you about it. They're not going to encourage you to do that because they want to make money off of you. So you have to be proactive, right? You have to be proactive, and you have to take that seriously. And it doesn't matter necessarily when you do it, but the sooner you do it, the better. Oh my gosh, my buddy, what's going on, man? I haven't seen you in so long. This is one of my data dudes. Join the Discord, man. We need some more of your data. This is a data dude recasting a mortgage. I mean, yeah, I mean, if you can recast it and lower the amortization schedule, and if it's a benefit, then yeah. And if you don't have to pay a lot of fees to do that, for sure. Let's see what Mav says. Travis, very few people live in a house that long. Yeah, that's true. You're right. So Mav, most move every 7 years. So only thing that matters is the payment amount. No, Mav, how are you only saying that, Mav? I'm not going to pick on you, but my God, brother, you've been watching me for so long. How could you say that? How are you saying that? And listen to what Mav just said. Listen, guys. Mav, let me pull up this amortization schedule again. Okay. So let's see. In 7 years, he said the average person moves in 7 years. So in 7 years, okay, of making payments for 7 years, I've only paid my mortgage down, let's see, $30,000. Okay. So in 30 years, I paid my mortgage down $30,000, but let's see how much interest I paid in that 7 years. Okay. So Mav, say you don't want to listen to me, Mav. You just want to look at the payment, just payment. Then you're going to be trapped like every other sheep in this world that's not paying attention. And I mean that with love. You know that, Maverick. Let me show you how much money, if you do it Maverick's way, you will be throwing away. Let's see. Boom, boom, boom. Well, not Maverick's way, but he's just making a point. I'm not saying that's your way, Mav, but he's just quoting something realistic. It's just that last thing that threw me off. Like, that's the only thing that matters. But he is right. That's the only thing that matters to most people. Okay. But let's do it his way. All right. So if I move, so after 7 years, Maverick, I have paid $148,000 in interest. Okay. But I've only paid my mortgage down $30,000. Let's add the $30,000 here. Let's see our total payments. So our total payments is $178,000, of which, you guys are getting this right? Of which only $30,000 went towards principal. So how much, guys, is really the interest rate? The sooner in the loan, the interest rate is actually higher. The interest rate is more like what, 400%? The reason I'm saying this, guys, is you want to be careful refinancing. All right. So if I refinance, I got to start all this over again. That's the concept I want you guys to understand. Maverick's right. And that's why we can get good deals as far as like most people just don't care. But Maverick, I hope you care, brother. I really want you to care. I can't make you care, but I want you to care, man. And that's why I keep going over this over and over and over again. And most people do not want to hear what I'm saying. I get these lives, guys. I barely get any views because it's all about like education, research, and empowerment. I don't know why, but we get penalized when we talk about stuff like that. It blows me away. So we're going to listen to our first video right now, you guys. And this is going to be on the rate cuts and the fact that they do expect the rate cuts to happen in September. But be cautious, guys. This guy's going to explain to you that just because they plan on doing rate cuts in September does not mean there's going to be a full-fledged rate cut cycle. If you guys can, let me know that this audio is okay. And please enjoy the video.
Citigroup Global Chief Economist Nathan Sheath. So where are we? How many cuts do we get this year and next?
My view has not changed appreciably over the last month or so. The cuts start in September. I think that's pretty clear. And they're going to continue throughout the year. If the economy is slowing more sharply and moving into recession, I think we get prepared for cuts at every meeting. On the other hand, if the data hold up and it's a little bit more soft landing-esque, I think the Fed will cut in December and then likely at a quarterly pace thereafter. I think the Fed's SCP is a good placeholder for that soft landing outcome. But clearly more stimulative monetary policy than what we've seen over the last couple of years is now clearly in the pipeline.
Well, it raises the question, Nathan, as to what kind of deterioration you expect in the economy from here and whether when the Fed begins cutting, that'll calm it down.
I think what is beyond debate, is beyond dispute, is that we are clearly seeing a slowing in the economy. I think the debate is not about what the data are saying, that things are decelerating. The debate is what happens in the economy next. And is this a prelude to the soft landing scenario that the Fed has been hoping for and working for? or will some of those sharper, nonlinear kinds of dynamics that we sometimes see when the economy slowed kick in? And to be candid, we have a vigorous debate inside of city economics on exactly this point. Our house call is that we will see a recession as the year proceeds. I see a strong case that it could be a soft landing, but it really is going to be in the data, and the Fed will respond more vigorously if things are softer. And I do think that that provides support for the economy. Whether that's sufficient to forestall further deterioration would remain to be seen, but certainly Fed cuts are a stabilizing factor for the economy.
Well, that's why, Nathan, the City House view has been so interesting for so long. I wonder, it's been a pretty busy week of I call it the why wait camp. Today it's the Journal and Bloomberg as well, saying that not cutting in July is really more procedural than economic. Are you surprised that there wasn't more of an effort to make July live?
This is a great question. I've been debating this, that it is clear that the balance of risks facing the Fed has shifted, that 3-6 months ago, it was this just laser-like focus on inflation. And now we've got to worry about inflation and make sure inflation is doing what the Fed wants it to do. We've also got to think about the economy, and it is a much more balanced outlook. And to get that first rate cut in up front is kind of a down payment, a little bit like what the ECB did. I think there's a case for. I don't think it's likely based on what I'm hearing from Fed speakers, but maybe they should do it. At a minimum, I think that Jay Powell is likely to signal that cuts are in the pipeline and try to set the table for September.
Right, because I was going to challenge the notion that, 1 or 2 cuts would have a particularly stabilizing or stimulative effect on the economy, because we didn't see that on the way up this time. And part of the reason is the housing market is funky. There's just low supply of homes. People are locked into mortgages. So it's not having that same kind of impact. If they cut a few times, is that going to stimulate the economy? It's not going to cause people to rush to buy mortgages. It'll still be in the 6% rate.
This is a very fair point, and broadly, I agree that 25 or 50 basis points on the Fed funds rate is unlikely to be a significant determinant of where the economy heads. However, what we also know is that when the Fed shifts the stance of policy, the markets extrapolate what's actually done into the future. And could we see, as the Fed starts to cut rates in a more convincing way with several cuts, that be propagated out the curve and have an outsized effect, say, on 10-year yields, which would be more important for mortgage rates? I think that is a possibility. So the big question is, as the Fed pivots, how decisive is that pivot? And how do the markets respond to that?
Okay, fair enough. All right, let's go real quick. You guys made some outstanding comments. I think we can have an entire conversation on just some of these comments. There's some people made some good points, some bad points, good points. But okay, so the first comment I want to pull up is from Mav, and this pertains to what we just went over. Mav is basically saying you get a tax break for mortgage interest and property taxes. You don't get a tax break for property taxes. Well, first of all, understand, you guys, I'm not a CPA. If you want any tax advice, you got to contact a CPA, but I want to talk to you from what I'm doing myself. You can't write off property tax. Property tax is something you pay unless you have a Schedule E, which allows you to claim rental income. And as part of your rental income claim, you can deduct property taxes, homeowners insurance, mortgage interest. Talk to a CPA. I can't, I'm saying, on my Schedule E. As far as the tax break on the mortgage interest, here's something that is a big deal. Okay, so that it's my own situation, I can claim mortgage interest as the tax deduction, but I personally, and it hurt me not having that this year. I had to pay more taxes, but it doesn't always benefit you. And in order for that to really benefit you, you have to exceed the standard deduction, right? And this year, you guys, I could not exceed the standard deduction because I could not claim mortgage interest on my personal my normal Schedule A. It had to go to my Schedule E because it's non-owner occupied. But Maverick's right. There's generally a benefit there, but not in every situation. Here's another one right here, guys. I lived in a home for 4.5 years and made extra payments. I got it back when selling. So even if it's short, it doesn't hurt. And I really admire them commenting this. Taylor's right. A little bit of extra money towards principal goes a long way. I mean, think about what I said, you guys. You spend $7,000 paying down your principal and you save $45,000 in interest in 2 years, for the first 2 years, right? So it doesn't take a lot to make a big impact. Good stuff, Taylor. Good stuff. All right. Okay. So let's see. P nice. Maverick's right. As long as you can make the payment, then you're all good. And the thing is this is the premise. And this is what I really want you guys to understand. And what so many people are missing. I understand making payments. You stay in your house. Okay. But if you listen to the video, as an example, Jack with Nobody Special Finance, he made his payments for 10 years and he still had to go to the closing table with $10,000 out of his pocket. So he wasn't all good, brother. He still had to pay out of his pocket because he purchased a home overvalued, and 11 years, sir. 11 years later, he had to come out of his pocket with $10,000. Okay. I don't know if you guys heard that. He was also fighting the HOA. That was a crazy story. So I hear you, P. But this is more of a comment that helps banks. As long as people are making their payments, then the banking sector will be okay. But when people stop making their payments, it all comes falling down. So P's like there's a lot of validity in what he's saying. But when we continue to think it out, right? And we look at okay, what are we warning about? Price decline, depreciation, inflation, being trapped. If we look at the fundamentals of what I'm warning you guys about, I mean, that's not what I'm talking about. Although it is important, the payment's important. If you lose your job, you don't make a payment, you lose your purchasing power, you go into foreclosure. It's all horrible stuff. But again, you got to look at the price. Okay, you got to look at the price. I know. P nice. Most people don't. Most people don't look at the price. But my buddy House Hacker looks at the price, although he's saying his payment's more important. Now take a look at House Hacker, okay? I want you guys to understand, you don't just refinance if the rate goes down 1 point. People are like, oh, what do you need to refinance? So the rates drop 1 point. That's not necessarily true at all. That's BS. It depends on your loan amount, depends on your savings, your 5-year break even, all of these things, your amortization schedule, how long have you been paying your mortgage? Look at my man, House Hacker. I refied my first house from 6.75 to 2.75. That is a 4-point difference. It took this man 4 percentage point difference to refinance. And I'm going to tell you guys, he had the option to refinance before that at 4%, and he still didn't. And he saved because that massive drop. So he waited. He was patient. He understood. He saved $500 a month, and he used that savings to pay the principal. And he was able to return to a 15-year mortgage. So he used his savings to turn that loan and the refinance into a 15-year, and he still cash flows $1,800. My point is, don't just refinance, right? You got to do it so you don't hurt yourself. Most people just hurt themselves with the refinance. They're just looking at the payment. Here's a good point. Some good points to say, House Hacker. Most of the time he has good points, to be honest with you. Now, House Hacker, he's saying a 2.75% rate is an asset. I got to agree. And I know, and we'll go into debt here in a minute, but I got to agree, House Hacker. I mean, how is it not an asset? I mean, we've never had rates that, and mine's 2.5%. I have a 2.5% 30-year fix. It's an asset. It's hard for me to desire to pay that loan off when the interest is so low. So I agree, but most people don't use it as an asset, Hacker. Most people don't use that as an asset. Most people just use it. Okay, now, the risk is transitory. I mean, trust me, bro. It's bro, I don't want to trust no one. I don't trust you, P. I appreciate you. I want to respect you, but I don't want to trust no one. I just give me the data and let me make up my own mind. That's why I put that up here. And the risk is transitory. It's not transitory if you lose your job and have foreclosure. Then you've lost everything and you have to wait, what? Yeah, it just depends, 5-10 years. So risk is transitory unless you get caught up. Yeah? Agreed? And please don't say, trust me, bro. That makes me not want to trust people. I don't want P nice. Don't trust me. Don't trust no one. Look at the data. Find out if you believe someone, find out for yourself. You guys got to be independent thinkers. I'm telling you, I swear. Trust me, bro. You got to be independent thinkers. Okay. P nice. I appreciate you, brother. Okay. So Arjun is saying debt is not an asset unless you're a banker. I put this one up here because the premise on debt is with debt, as long as you're using it the right way, you can advance yourself. And my point in Arjun is this. If you get a home. You buy a home, say you purchased a home 5 years ago, used an FHA, you only put 3.5% down. Well, that home is now probably worth $200,000 or more. So that mortgage debt, although it is a liability, that's the other part here. It is also, it's a liability and potentially an asset. That's I want to correct this. So it's a liability, I agree, but it does have the potential to be an asset as long as you're doing the right things, Wedge, cash flow, making good decisions, right? Because I made $200,000 if I sold that house, Argent. So I needed that debt to make the $200,000. But there's always a but. Most people don't do that. So to his, I mean, they got a point. They got a point. I'm just looking at all scenarios, you guys. Okay. Let's see here. How's our trust? I love you guys. I love you guys so much. There's my buddy Jason. What's up, Jason? I love Jason. I love this guy. You know, Jason, I see you doing well, man. I see your channel's growing again. I love this, man. I'm going to tell you, I've been listening to Jason I've been doing YouTube for about 2 years and 4 months. I've been listening to Jason for almost 4 years. I'm not joking. Before I became Real Estate Mindset, I used to do seminars and trainings, and I used to bring up Jason all the time. Because a lot of my trainings were on like YouTube with realtors, and I was like, realtors, blah, blah, blah. And I'd always bring up Jason. I'd always bring up Scott Walters and Jason. I'd be like, here's Jason Walter, here's Scott Walter, two totally different guys, both very, very successful on YouTube. Jason, I appreciate you, man. You were a hero to me, man. So I want to go into our real estate section now. This is going to be super spicy. I am lagging, guys. It's just been so long since I've been doing lives. I have been just taking so many hits. Right? It is what it is. Okay. Here's what I want to talk to you guys about. First of all, when it comes to real estate, so we're on a real estate section. I want you guys to understand we can't be looking at median. Okay, when we're looking at median, it's not true median because they do price buckets and price groups. You guys got to go hyper local. You got to do the subdivision analysis. You got to do the subdivision review. And I'm going to tell you why. All right. I'm going to give you case in point. I'm not just going to use my emotion, just a little bit of emotion, not too much, just a little bit, just enough, right? Just enough to make it entertaining, hopefully, or to just make a fool of myself. But I want to go and I'm going to show you guys 4 different companies. I'm going to show you 4 different companies. I'm going to show you Redfin, Zillow, National Association of Realtors, and Realtor.com. And I'm going to show you how each of them has a massively different median sales price. You guys, if anyone is making price buckets and price groups for median, then they are manipulating the data. It's not a true median if you're making price groups. I hate that because it's cheating us. It's cheating us the data. But here, let's start with Redfin. Okay, now this is June. I'm going to go to May. Okay, you guys can see May there. So Redfin has May median at 438,000. You guys can see that right down there on the screen, 438,574. Okay, now let's go to Zillow. Now Zillow has for median 360,310. That is a discrepancy of $78,000. So if there's a discrepancy of $78,000 between Redfin and Zillow, who can we trust? Does that mean they have $80,000 in juice to manipulate us with the proprietary ways they're coming up with what they call median, which is not. That's not real median. If they do any manipulation to that price or anything at all, it's not a true median. You guys, that is a massive discrepancy. Now let's look at this. This is crazy as well. Look at this. Let me breathe. This is the National Association of Realtors. National Association of Realtors has it even different, way different as well, at 419,300. So we have a 438, we have a 360, we have the National Association of Realtors, who hopefully goes away soon, at 419. Now let's look at Realtor.com. Realtor.com is the highest. Look at this. So Realtor.com has median sales price for May at $442,500. That is a difference between between Zillow of $82,000. You guys, there is a discrepancy in data of 18.5%. So please, guys, explain to me, how can we trust these people? How can we trust them? If everyone has different information, if there's massive discrepancies, if it's proprietary, if they're changing price cuts, as a consumer, how can I trust this info? I think the answer there, guys, is that I cannot trust that info. And unfortunately, we're stuck with this. Okay, this is MLS. This is the MLS right here. So here's what I want to show you guys. when it comes to MLS, essentially, especially if you're a realtor, not all realtors understand this. The more that you add filters, the more you can narrow down your results. I'm going to show you an example. So let's look at Houston real quick. In Houston, there's an over one. Okay, so when I first pull up Houston, there's like 15, 20,000 listings. There's so many listings, it's not even showing it. Okay, there's like 20,000 listings. Okay, now if I'm looking at 20,000 listings, and this is to realtors as well, if I'm a realtor, I'm representing a client, the client's already stressed. You want to help the client out. You don't want to just throw up on them. You want to say, hey, what do you want? What do you need? Price, preferably price, wedge, cash flow. And what you do is you go back and you start filtering this. Okay. Now, what I would suggest that if you do have a realtor, or you're thinking about it, or you're shopping them or whatever, have them set up a data search for you. And if you're a realtor, all you have to do is you have to add, first of all, this is the matrix. So I had an additional field, and I added price per square foot. And now look at, guys, if I put 0, you guys know that I love $120 a square foot, to $120 a square foot, it goes from like 20,000 listings to 3,000. So now I have just saved myself, 80% of the work? You guys, you have to add your filters. So let me go back to the map. Look it, now it's a lot easier to see what's going on. I don't want to look at all of the overpriced houses. I don't care about all of the overpriced houses because I'm not going to buy one. I care about the sellers that are in distress, and I'm asking why. Why are all these people? Why can't they sell? These are all, this is a crash, guys. A crash is going to look like this, except more. This is crash-like stats that you see on your screen. Now, there's not 20,000. There's like, 10%. But this is how you do it, guys. So if you're stressing, and look at Kingwood. Here's Kingwood. Remember how I'm always looking in Kingwood for 120 a square foot? Look, I already have it set up, guys. I'm making this so much easier for myself. Let's click one. All right, let's click this one. This one's for 355. Let's see what's going on here. Oh, dang. This is a good one. Oh, my gosh, guys. Oh, my. See, I mean, you don't know what's going to happen. Oh, my God. They just reduced this $10,000 2 days ago. This is $112 a square foot. Holy smokes. So this is a 3,000 square, this is almost a 3,200 square foot home for 355,000. That's $112 a square foot. Remember, I like to look at property archives to see, history. So let's see their history. Okay, so it looks like they bought it for $264. So they got like $80,000 in equity right there. But oh my gosh, guys, this is crazy because this is in a nice part of town too, and we'll look at the DOM in a minute. Let's look at the condition of the house. You guys think it's going to be junky? Let's see. It's under market. Oh my gosh, dang, y'all. We're talking about a home, okay? That's like maybe 15% off peak. This is like, I have to do the analysis, but probably 2021 values. You guys are looking at a home right now with massive wedge 2021 values, and look at the condition of this house. This is not a fixer-upper. Let's keep looking. Dang, this is a two-tone. Oh my gosh, look at this. I don't like the ceiling though. I don't like that popcorn look. It's kind of takes away from that modern, refurbished type look. I hate the popcorn ceiling. They didn't do too much with the kitchen. They just repainted the kitchen, put some granite countertop, and put some stainless steel. That's really all it takes. It still looks pretty nice. Put some chandeliers. That's a decent kitchen. Small, but it's decent. I don't know about the flooring, but it's decent. This is decent, guys. This is crazy. Look at the bedroom. Now, remember, you want to look at another thing as well. Let's look at DOM 58 days. Anything over 30 days, I'm telling you guys. You guys see what I'm saying? Leading indicators are what? I have 3 leading indicators I've been trying to preach about for I don't know how long. Inventory, price cuts, days on market. Inventory, price cuts, days on market. I have more inventory in Kingwood than I've had in like 3 to 4 years. So I have my inventory. Here's my price cut, $40,000 in total price cuts. And here's my DOM over 30 days. Do y'all see the recipe? Y'all see the recipe? I mean, you guys, there's no guessing. This is what's happening. People still think I'm guessing. Oh my God. Okay, so there's your DOM. We looked at the property archives, and one thing you always want to be careful of is those adjustable expenses like property taxes and insurance. Now, what I do, guys, is before I'm even under contract, I'll call ahead and get an insurance quote. So I'll call ahead and get an insurance quote, but I'm always looking at property. So it's a 3% commission right there. Okay, so take a look, guys. So this is a really low property tax rate in Texas, 2.269%. But oh my gosh, dude, look at this. That's crazy, guys. So the tax lab, so that's what makes it like if you're an investor, you want to invest in Houston, good luck. Because our property, I can find wedge in Houston all day. House hacker, I find wedge. This is house hacker's point. I'll find wedge all day. But when I start looking at cash flow, dead in the wall, I'll find $50,000-$60,000 in a wedge, and it still doesn't cash flow because of what you're looking at right there. Who wants to bet that the county has assessed this property for too much? You know what? Let's do a search. Okay, so it's for sale for $355. Let's go to HCAD and let's see if they are getting cheated by the appraisal district. All right. Anyone want to guess? Comment below. Do you think it's being overvalued? Okay, let me go to my property search here. Okay, so remember there again, maybe it is, maybe it isn't. Let me know if what you guys think. Let's go property search. Come on, guys. What's going on here? All right, here we go. Paste. All right, so remember 355 and they can't sell it. Let's see what it's being assessed for. Come on, man. Oh, you have to abbreviate drive. No. Boom, boom, boom. Here we go. All right, let's see. Is it 355? Let's see what it is. Is it 355? Oh my God. See what I'm saying, guys? See what I'm saying? I am trying to show you guys. The county is taxing them as if that home is worth $403,000. They can't even sell it for $355,000. It's been on the market for almost 60 days, and they've had $40,000 in price cuts. It's in decent condition. It's under market value with wedge, and they still can't sell it. If it's me, actually, I have a situation like this, so it makes me really, really upset. But look, guys, you see, they are overtaxing us. They're overtaxing us in Texas. They're overassessing our value. In Texas area, we already have declining values. We already do, despite what you hear in mainstream media or any of these like really radically emotional realtors. Look at 403, and then in 2023, 408. So in 2023, it was 408, and then they're like, wait a minute, they got it down to 403, but look at 2022, it's 351. So they're trying to sell it for a 351, for 2022 assessed value. But remember, you guys, each of these tax years is the preceding year. So 2022 is really 2021. Okay. 2023 is really 2022. 2024 is really 2023 because they use old comparable data to calculate assessed value. Pretty cool or no? I thought that was pretty cool. In other words, guys, be very, very careful on who you're listening to when it comes to prices and median sales value. So we're going to go on to our next video right now. Let me do my timestamp real quick. This next video, you guys, is on how the consumer is absolutely suffering, especially when it comes to the housing market. And that is one of the things I'm saying is that's why it's not sustainable. Consumers just cannot sustain the value of these houses. It's just too unaffordable. But let me know that the audio is okay.
Today on housing, June housing starts stronger than expected, driven by multifamily activity. Single family starts and permits pulled back, though. Home builders have been on a tear lately. After June CPI report showed inflation cooling and boosted the odds of a Fed cut. So joining us now, Zelman & Associates Managing Director Alan Ratner. Alan, it's great to have you back on. That's exactly where I'm going to start, because we've seen this stagnation, stagflation, if you will, in the housing market. What shifts it? And what's contributing to the run recently we have seen in the home builder stocks?
Hey, Morgan, thanks for having me. Yeah, the last several months, I would say the new home market has been pretty stagnant. The spring selling season got off to a good start earlier in the year. And right around March, April, we started to see things hit a little bit of a wall, not falling off of a cliff, but I think what we're seeing is the consumer is just struggling from an affordability perspective, with rates, albeit down more recently, still hovering in the high sixes. Prices are up a lot. And, at least from an employment perspective, things have kind of slowed down a little bit. So a little bit of a digestion period. What the market is showing right now, though, is a lot of optimism that the tamer inflation metrics are going to translate to much lower mortgage rates in the back half of the year and kind of solve that affordability problem. And that might be a little bit of an optimistic view.
Why is that optimistic? Because at most, maybe you get 50 basis points and it doesn't really change the equation that much?
Well, not to get too technical, but the bond market's already pricing in rate cuts. So the simple act of the Fed cutting is not necessarily going to have a direct impact on mortgage rates. Right now, the bond market is already pricing in that outlook. So We'll see how far rates actually move lower, but our view is it's going to be a fairly gradual decline over the next several years as opposed to a step function lower.
Alan, we talked a lot about supply lately, lack of it, and how that's affected keeping prices higher. But how does a weakening consumer potentially affect home builders? What about demand?
Yeah, it's a great point, John, because the one thing that trumps lower rates is a recession. So what we've seen historically is a slowing economy, a slowing job market. That's going to overwhelm any relief we might see in mortgage rates, at least as far as fundamentals are concerned. The stocks might react in advance of that and kind of with the anticipation that the recession might be short-lived and ultimately Fed stimulus and lower rates will kind of spur demand and spur the economy. But we are concerned about the direction of the economy and the consumer. And right now, if we can orchestrate a soft landing and lower rate environment, that is the Goldilocks scenario for housing. But it's definitely threading a needle.
Yeah, so far.
All righty. I mean, I think. Do you guys feel the inflation? Do you guys feel the inflation? I feel the inflation. All right, we got some really good talking points here. Let's throw some up. Let's see. The first one is okay. We already did this one. Okay. All right. So Matt, I got some Mav. I got P Nice in the comment section. You guys keep talking, man. I appreciate you guys talking so much. I do. So Mav is saying, don't trust those pictures. Something is wrong. So basically the pictures that I just pulled up, and honestly, a lot of times when you look at pictures, it's like almost all the time it's off. Like it's almost always worse. Sometimes it's better, like very rarely, but it's usually worse. But Mav, like, dude, there is something wrong, but Mav, what's wrong is the price and the affordability, brother. There's something wrong. The reason why that's staying on the market is because the affordability. Did you see the property taxes? Did you see the property taxes, bro? $9,000 a year on property. There's something wrong, but it's not necessarily. There could be something additional wrong because the pictures, bro. It's the friggin' price, man. Like Maverick. What are the leading indicators? I'm not pulling up any more of your comments except for one more because I already put it. I'm not pulling any more of your comments up, Mav, unless you tell me the 3 indicators. I want you to comment the 3 leading indicators I said watch. Okay, what are those 3 leading indicators, Mav? Also, don't go drinking, Maverick. That's going opposite of what I've been saying. Save your money, brother. Save your money, brother, if you can. Going out to drink is like you pay 500% more than what you could at home. I mean, why not just go play Settlers of Catan and drink some tea? Okay, you guys get it? All right. Date. He's right. Oh, this is a good one. He said, date the taxes, marry the house. Now, I want you guys to, this is a good point. Taxes will fall when the crash comes, bro, but not at first. Remember, like I said, the assessed value is 1 to 2 years behind. So 1 to 2 years behind. So like 1 or 2 years after we have comparable sales and crash and lower prices, 1 to 2 years after you get relief, bro. Like, you're not going to get relief at first. That's what I'm trying to explain and prepare you for, okay? It takes a minute because remember, they have to sell, they go back out, they reassess, and they only reassess once a year. Okay, so, and then they're saying, careful, remember, hey, Edward, if something is too good to be true, just saying, double, triple check everything always. And to his point, he's absolutely right, guys. I mean, you can't just take price per square foot. You look at multiple things: the smell, the neighborhood, the school districts, the condition of the comparables, the condition of the subject property, inspections, roof, foundation, leaks. You walk in the attic, you walk the property. You don't just look at price per square foot, but the price per square foot, it is a great way to take 20,000 homes for sale and narrow that down to 400, say, as an example. So let's go on to our liquidity and recessionary indicators right now, y'all. Okay, I like this one. This is one of my favorite things to do right now. Okay, so we're going to look at our recessionary indicators, starting with the recession indicators. So this is one of the primary recession indicators, the 10 and the 2 inversion. We're sitting at 26 basis points inverted. It appears we're on our way to recession. It appears like the pain is coming, but we need that to go over that black line. Usually that's when that real bad stuff happens, which means unemployment. And then with the unemployment, we'll see more bankruptcies, foreclosures, companies going out of business, Chapter 7, 11, 13, all of that stuff, more defaults. We already have a lot. But that 10 and the 2, you guys, huge indicator, very, very trusted set of data. If you want to trust headlines, that's okay. We know there's a financial bias, but this is where people put the money where their mouth is, right here. Okay, this is a really good set of data. We are still inverted. This is a huge indicator of incoming recession. Here's another indicator of incoming recession is the trajectory of the unemployment rate. Anytime unemployment, like here, look at the GFC. Okay, we started at what, 4.5? What was it go down to? 4.4. So we're at 4.1. Okay, during the GFC, we started at about 4.1, and look, it just went right up, and then boom, recession, bam. So again, anytime that unemployment goes up, recession, boom, recession. And this, look at this recession. Let's see, it was down right here. Start at 3.8. So the dot-com recession was actually a lower unemployment rate than one we have right now. It starts going up, and then recession. You guys, when unemployment goes up and ticks up, that's recession. And by the way, this recession, we did have nationwide price decline, despite what people say. We know this. It's in the data, right? So there is price decline that's happened outside the GFC numerous times. On a nationwide average is what I'm talking about. Now look at this other thing, guys. Okay, this is the deficit. Let me just read this clause real quick. The size of the national deficit or surplus is largely influenced, here's the key, by the health of the economy. And remember, you guys, the deficit year to date is 1.26 trillion. If we compare that, not adjusted for inflation, but if we compare that to the peak of the GFC for the entire year, the deficit was 1.42 trillion. We will surely exceed that this year. When you adjust for inflation, I think Mr. Watson and I actually did the inflation breakdown, and this equals 1.9 trillion. So when we adjust 1.4 for inflation, it's actually 1.9 compared to today. And we're probably going to exceed or get close to 1.9. So even if we adjust for inflation, I mean, come on, right? All right, so those are some primary indicators of recession. I mean, it's clear as all get out. But let's look, you guys, let's look at where the inflation's coming from. Let's look at the liquidity in the market. And I want to remind you guys, you see this map. Okay, first of all, what we're looking at, assets held by the Fed. Okay, assets held by the Fed. Let's not forget this, okay? This, I used to call that a bank bailout. Maybe it's a mini bank bailout. Danielle doesn't want to call that a bank bailout. But this was absolutely a second round of inflation and an additional shot of confidence and trust. They're like, we can trust and have confidence in the Fed put. That's what that is right there. So not only did they add inflation, they changed our mindsets and we started being confident and trustful again. This was a huge problem. Okay. That was, again, the bank runs. When those bank runs started happening, they're like, nah, we're going to meet on the weekend and we're going to stop this and we're going to trick the public. But either way, they've been doing quantitative tightening since then, a little bit here and there. Take a look at this, guys. This is the reverse repo market. We're pretty much stuck here. I mean, we've been here before. We're at 391 billion. Hopefully that sucker will go down. I mean, this is just insane. The money is stuck. It's like it is stuck. But we can't buy anything because every asset's overvalued. What are you going to buy, guys? You're going to buy an Nvidia, Tesla? What are you going to buy? You're going to buy a house blindly? I mean, what are you going to spend your money on that's not overvalued? It's stuck. This money's like stuck. It's crazy. Here is quantitative tightening and quantitative easing. This is the Fed's mortgage-backed security holdings. Okay, this is how we can get rates low and high, even if the banks don't want to. Here's what I wanted to show you. Let me throw up the 1 year. There's actually been periods where they've increased their mortgage-backed holdings. So although it's trending downwards, there's actually times and periods where it's gone up. So they're not doing a great job like maximizing quantitative tightening. They are doing quantitative tightening for sure, but they're not maximizing it. I think they could do it a lot faster. Okay. Let's see here. And also look at this. Okay. I just wanted to throw this up here to remind everyone what I'm saying and why I'm saying it. Median household income after taxes fell 8.8% in 2022. So I'm pulling 2022 up because that was mostly when we peaked in the housing market. So at the same year that we peaked in the housing market, income fell, and this is not adjusted for inflation. This is just after taxes, 8.8%. So when we adjust that for inflation, how much did income fall? Okay, we see that here, real median household income. Consumers are making less money. They have been since 2019, although this is lagging data. I suspect recently this actually has a reverse trend. And in addition to that, when people make less money and it gets more expensive to live, then people don't save anymore. So not only is excess pandemic savings gone, the household savings rate is only 3.9. Again, just demonstrating people can't save, overwhelming unaffordability. And when people are making less money, they can't save, then they stop being on-time payers. And you see that with the delinquency rate of credit cards surging. This is also lagging data, you guys. In other words, what I'm really trying to paint the picture here is how unhealthy the consumer is right now. And if people are saying that the consumer is resilient, I don't buy that. It's very frustrating for me to hear people say that the consumer is resilient when the trajectory of debt is exploding, income's going down, savings rates going down. So when people say the consumer is resilient, all they're saying is they have more money to charge on their credit card. They have more debt to get in. And that makes sense because we are in an economy that's debt driven. We're in an economy that is relying on the consumer to make foolish decisions. The economy needs you to spend your money recklessly. The more recklessly you spend your money, the more profit that these people make. So you got to care. All right, let's listen to our last video. This is from Logan. You guys. So Logan is basically saying it's too soon to cut rates. Let's see what he has to say.
Housing application starts and permits. Some of this growing belief that we're getting a rate cut, will it possibly show up in this data? I know it's backward looking, but we've been seeing growing hopes for quite a bit of time.
The builder's confidence data that looks out 6 months, it had a little bit of slight uptick yesterday. So, rates have actually fallen a little bit more than 1% since the highs of last year. So it's a little bit too early to get any of the lower rates into the data line. But I think the story going out is we're worried about construction labor. Multifamily permits are near recession lows. Single family permits have been falling. So you want to keep an eye on single family permits when the housing starts data comes out today and see if the decline in the last few months have settled down any.
All right. I always thought real estate was about location, but apparently it's about inventory, Logan. It's really about inventory, at least nowadays. So inventory is growing. According to your data, back in March of 2022, we had 240,000 single family homes for sale. Last week, you said that's 650,000, obviously more than doubling. But here's a real question. Is that enough to meet demand? Is that enough to lower prices that just seem to keep going up and up?
Price cut percentages have been increasing since the end of March. So the price growth data should cool down this year, and especially in the second half. But I think the best story for housing 2024 is that inventory is off of its extreme low level. So if mortgage rates go down towards 6% or lower, we're going to have a lot more choices for Americans. We're not going to have this 75 or 80% of the marketplace be multiple bids. So I think that's the positive story. We're ready for lower rates if it happens, where we weren't ready for lower rates in 2022 and 2023.
All right, so you're saying if it happens, we're ready. One area of the housing market that has been a lot of questions about just due to the rise of prices is the lower end and the middle tier when it comes to housing buyers. When we look at that inventory, how much of that is priced for them?
Unfortunately, affordable housing is almost like a myth here in America. Inventory is growing generally on all levels, but more than 40% of the growth in inventory comes from Texas and Florida. And a lot of that is basically property taxes and insurance has made housing less affordable in those areas on all price.
The price made it less affordable.
The only way to alleviate affordability is either rates come down low enough or rates and prices come down. Prices, it's on a national level, we're not there yet. But affordability will happen when rates come down and wages grow. So this is going to be probably a multi-year process.
Talk about price ever.
But we are in such a better spot.
I think he's paid to not
if rates fall. I don't think we're going to get the 10, 15,
you guys see what I'm saying? Like he will always skirt by
ever
price.
Again, as long as inventory stays at this level and keeps on going higher, that'll be good over the next few years for the housing market.
I don't think he's allowed. I honestly, that's the only thing that makes sense to me because I'm going to be honest, guys. Okay. And I saw some of those comments here. I appreciated him. Let me explain, please. Okay. Don't knock me. I appreciated him coming on because as much as you guys don't want to hear it, I think it's a really good thought exercise. I think it's so important to listen to people that don't agree with us. I think it's so important to understand why they're saying what they're saying, to try to gain their concepts. And if we don't agree with what they're saying, then it allows us the ability to go research what they're saying and figure it out. And that's why I like it. And I appreciated him, and he's willing to come back on. He wants to come back on. And since that last show I did, I guess it was a debate. I felt I was too aggressive, but honestly, ever since then, I went back and I checked on his stuff and I learned even more and things that actually support what I'm saying. So I know you guys don't want to listen to him and to people that are a little bit bullish, but I got to tell you, man, I mean, I think it's incredibly helpful. I think it really strengthens us. Oh yeah, we already got this one. Julius, welcome to the Thunderdome, brother. Appreciate you. So let's see here, guys. I think am I ready to wrap it up? So did anyone get, what are the three main things? What are the three leading indicators? Do you guys remember? Commission, bro. That's funny. New bet. Thank you. Thank you, Nikki. Got my son here. I hope you guys like that video. I'm putting that video out today about, downtown Houston. But you guys, just this last thing, if you guys can, what are the three leading indicators I'm watching for the housing market on price declines? I've been talking about this for like 6 months. I want you guys, what are the three things I'm watching? Three data sets I'm watching. I gave it to you yesterday's video. I gave it to you at the beginning of this video. I want to know that you guys are growing by watching my videos. I don't want you guys to just watch them because you think they're entertaining, or you just want the doom and stuff like that. I want, please, guys, where are the comments at? Someone comment. I'm getting freaked out. Someone, yeah. Okay, no. John Doe commented. DOM, that's one. He got one. Guys, I need to know you guys are getting this, please, for me. Okay, so just stop what you're doing and type. All right, so he got one. I need two more. Days on market is one leading indicator. There's two more. Days on market and price cut. There we go. There it is. There it is. There it is. There it is. There. Thank you, guys. Thank you so much, guys. Thank you so much, guys. I am so proud. This is what makes me want to keep doing this. These are the comments that makes me want to keep doing this. Thank you, guys, so much, man. It means so much to me. I mean, see, Mav, even Mav gets it. He's stressed. I know you're stressed, Maverick. I know that. But honestly, man, it's like, as long as you know what I'm talking about, bro, I think you're going to be good. It's right. It's days on market, price cuts, and inventory growth. Those are the things you want to look out for. You're always going to want to do a subdivision. You're always going to want to try to love some people. Look at House Hacker. Me and House Hacker used to butt heads. Now he's out there because I'm calling him out. I see him on other channels, and this was in the past. Dude, look at House Hacker now. I feel like House Hacker is like a pillar of the community now, right? He's, so I guess what I'm trying to say is love some people, have some thick skin, don't get so offended, and if, having said that, if you're a troll, buck up a little bit. Everyone is laughing at you. Stop trolling, start helping people. It's a way better life to live. Just help and love, right? I understand frustration. We can't trust the government. All right, who do you trust? The mainstream media or this stupid YouTuber? Mainstream media, stupid YouTuber. It doesn't freaking matter. Just understand the concepts. You don't have to like me. I prefer it. You don't have to be my friend. I prefer it. You don't have to agree with what I'm saying. I have the data. But as long as you guys are getting the fundamentals and the ideas of what I'm saying, I'm telling you, you're going to be ahead of 99% of the consumers and even the professionals out there. No one talks about this stuff, you guys. Lock it in. What I'm saying is how it works. There's no guessing here, all right? Do the stuff. Do your homework. Love some people and understand this. Always understand this, okay? Always, always, always understand. I love you and I do this for you. And if you guys aren't learning, if I don't see the love, if I don't see the community, if I don't see the unity, I got to get another job. I'm a teacher. I'm a teacher. All right, guys, I appreciate you. You guys have a great weekend. Don't drink too much, all right? Try to save your money. And if you can, hey, I want to challenge you. If you really want to get ahead, if you really want to be a winner, okay, you say, oh, I want to be a winner. I want to get a great deal. I'm listening to Real Estate Mindset. If you're really listening, let me challenge you and take me up on this challenge, you guys. And this is from a place of love and care and empathy and compassion. Rebudget this dang weekend. You got to sit down. You better rebudget and you look at your subscriptions and you look at how much money you're spending on food and you tell me that you're saving money. You tell me you're living the right way. I don't buy it. I think we all have work to do and I want to be here leading you on that way. I love you guys. I appreciate you so much. If you're out there investing in real estate, you guys already know I wish you luck. And I do. I really do. I do. I hope you win.